Hello everyone. Welcome to the first session of the Connected Climate Change series, hosted by Scottish Power, the University of Strathclyde and the University of Glasgow. Over the next few months, this series of events will provide a platform for businesses, academics, students, and the general public to engage with climate change topics in the lead up to COP26, which, as many of you know, will take place in Glasgow in November this year. My name is Lottie. I'm a board member of 2050 Climate Group. We're a youth climate organisation here in Scotland. Our mission is to engage, educate and empower young people in Scotland to take action on the climate emergency. And we do this through our Young Leaders Development Programme, various policy engagements, and by connecting young people through our Leaders Network. I'm super excited to be here today to welcome you all to this first event of the series called Climate Change, the Financial Conundrum of the 21st Century. We will cover a bunch of interesting topics, and I'm really excited to learn more about what it actually means for businesses to make financially responsible climate-friendly decisions. There's many strategies out there that businesses can take to tackle the climate crisis, such as reducing their carbon emissions, moving to more circular business models, investing in social enterprises, or through investing in green technology. And our speakers will be discussing the importance of transparency and responsible decision making that can lead to a sustainable future for all. You won't just be hearing from me, because first we'll listen to two short presentations by our panelists from the University of Glasgow and University of Strathclyde. After that, we'll be joined by Charles Langen from Scottish Power. He will join us for a panel discussion after the two presentations. During the discussion, we'll really like to make an interactive discussion. So I will be asking questions that come from you, the public. So I'm hoping that you will feel encouraged to submit any questions you may have for any of the speakers, and you can do that through the Slido platform. As you can probably see, there is a box at the bottom of your main screen where you can submit any questions you have during the entirety of the session. You might not be able to see the box where you need to type if you're watching this on full screen mode. So if you have any questions to submit, I would advise you go back to a reduced screen mode, and then you should be good. Before we go to the Q&A, we're going to watch two videos. The first will be from Professor Duncan Mclennan from the University of Glasgow. Professor Mclennan is an applied economist with a special interest in cities, infrastructure and housing. His current research focuses on economic drivers and consequences of metropolitan investment in housing and infrastructure, and on the fiscal and spending autonomies in subnational levels of government. I hope you enjoy, and I'll see you after.
I'm Duncan Mclennan, and I've been asked to speak about climate change, the financial conundrum of the century. I want to broadly consider conundrums. I want to consider the context that we're dealing in, and actually to think about the challenges of making the finance sector more effectively green. Well, when we think of the notion of a conundrum, it's sometimes a riddle that's humorous, that's usually solved by a deft pun, or it can be a complex, serious, difficult, interconnected set of issues. That's the sense in which conundrum is relevant here, because climate change poses for us all, at the very worst, an existential threat to ourselves as individuals, to our businesses and our governments and their stability. But at the very best, at the very least, it implies major shifts in social and economic behaviours and in patterns. It's got complex patterns of gainers and losers from change that need to be identified and governed. I want to be optimistic and suggest that in many facets of climate change, we are actually moving beyond conundrum. In other words, ignorance and doubt is no basis now for change, particularly in the scientific and commercial realms. But when we address these issues and solve the conundrums, a conundrum resolved becomes a challenge for action. So it's a challenge for actions that we have to face too. I don't think that COP26 is going to be about revisiting conundrums. Clearly, the spirit of the times is about identifying the challenges and the responses to governments, firms, and all of us as consumers and citizens. When we look at economic change or system change or greening finance or whatever, there's usually a sequence of things you can observe in the innovation process. There's the idea, there's risky early investment, there's more mature certainty, more players come in, less concerned with risks, and there's swarms of innovation, as Joseph Schumpeter talked about. And examples we can find of that in the tech sector, closer to home in Glasgow. There was a revolution in the financing of social housing that allowed us to create things like the GHA and rewire the way in which money delivered social housing objectives. Equally, we're rewiring the system so that money effectively and markets deliver effective sustainable development outcomes. Now, to reach that, we have really 5 revolutions that are required. There's a revolution in scientific knowledge and earth science. We've made significant progress. No longer there's many conundrums, a lot more established understandings. New technology, solar panels, photovoltaic, hydrogens. Again, an innovation swarm in the last 4 or 5 years, and a really positive prospect for their role in driving economic growth in the context of sustainable development. So again, a revolution that is well progressed. Refashioning connections between lenders and borrowers, in other words, in the financing system. I'm just going to touch on just taking off. The green financing revolution is not some futuristic idea. It's here, it's now, we're in the middle of it, we can still influence it. The other revolutions are about funding, in other words, how investments are paid for. And if these require revolutions in consumers and their willingness to pay and their willingness to support government programs, and equally, a further revolution is in governments and their understanding. Do they take on the long run? Do they look to partnership? Do they look to local as well as global? I think that many of the challenges that we will have beyond COP26 are not going to be about reconfiguring the finance system. I think we're well on our way to doing that, but actually reconfiguring the funding dimensions of the investments that we have to take place. Neither citizens nor governments, in a sense, are keeping pace with change in the financial sector. Why am I optimistic about green finance revolution? Why is it lifting off? At the start of 22, the CEO of BlackRock, which is an 8.7 trillion funding house, set out his green requirements for his company, but also what he'd be looking for in terms of sustainable development arguments, risks assessments, information, scenario building, and so on the part of borrowers and lenders. That made a major statement to the financial sector on both sides of the Atlantic and further afield. And actually, a recent Financial Times review of how BlackRock had delivered in the last year would suggest that they've progressed significantly on the outcomes that have been espoused. Of course, pension funds and insurers, they have a long-term eye, not only on the sustainable development effects of the investments they support, but how sustainable developments influence the viability of their assets and their funding positions in the long term. So much interest in big players within the financial system. Last year, in 2020, green finance was the fastest growth sector in the City of London. There was something like 300 billion of bond financing, green bond financing launched, and it's expected this year that that amount will be of the order of 500 billion. Now, that's still a small slice of funding that takes place, but what it's suggesting is that there's real traction in these developments, and what we really need to be sure is that the fundings are looking at the way in which borrowers and lenders are being savers and borrowers are being effectively interfaced by the institutions and rules that prevail within the finance system. In the finance system, I think the key challenges in lifting off are education of financial professionals in all roles is a critical thing for the system as a whole. And particularly one might observe that accountants have to move from being seen to be a rather grey profession to perhaps a stunningly green profession if all this is to work effectively. We need feasible metrics of the relationship between investments and environmental outcomes. We need regulation that's creative and evolving, and the FCA, I think, have demonstrated a good track record in that regard so far. Central banks have to look at reweighting the risk categories and risk allowances for environmental investments. Banks need KPIs that engage with the environmental sector, and we need, obviously, real transparency on the part of corporate borrowers, both about the source of funding, the process of funding, and what funding is actually intended to do. If one looks not just at the system, but individual corporates as a whole, we have to strengthen corporate sustainability governance, and I'm seeing that sustainability arguments and strategy, information and audit, companies like Scottish Power or Aviva are another good example who have embraced that spirit, and we can see a significant number of firms progressing in that direction. We need to see that firms and financial institutions price climate risk into valuations of new projects, strategies, and existing assets. We need to see an alignment of profit and environmentally sustainable development goals, and that's going to mean a significant revision in business meanings and models. We've started. I've been optimistic about the change. That said, if we look at the FTSE firms in the UK, 85% of them have no real green strategy yet. Fewer than 30% actually use environmental scenarios in assessing and building asset strategies. And actually, if you took FTSE firms at the moment as a representation of future growth, then would be probably aiming for something like a 4-degree centigrade rise by 2050 rather than 1.5. So optimism, but continuing concerns. Concerns would be we need a faster, wider response. Perhaps we need to move to mandatory regulation regarding assessment and disclosure. The attention needs to move not beyond the corporate sector and capital markets, much more thinking about the banking sector and small and medium-sized enterprises and regulation and operation in that regard. The focus of investment needs to go beyond energy to thinking much more about infrastructure and agriculture, which are other key sectors of adaptation as we move towards more sustainable development. We also need to think about local governments and communities and what are they doing and what's the interface between the private sector and government in these different roles and actions. I think in many ways, financial markets and financial systems, because of the changes that have happened in the last 5 years and the resource flows that are appearing, are I think now running ahead of the willingness of governments to seize the issue in terms of tough decision taking, and running ahead of citizens' understanding that to move to a different level of well-being and different ways of living, we do have to actually address the revolutions that are unfinished in the dimensions of funding whilst the finance revolution continues.
Welcome back, everyone. It was really great to hear that optimistic message from Professor Mclennan. I make sure that we'll circle back to his point about the need for increased customer understanding of green issues. I thought that was really interesting, so we'll make sure to raise that during the Q&A. Before we go there, we're going to hear from Dr. Andrea Coulson, the second speaker today. Andrea is a doctor at the University of Strathclyde. She has over 15 years of experience working in the financial services sector. She works on perceptions of social and environmental risk and valuation, And her research focuses on accounting for risk and accounting and social and environmental accounting. I hope you enjoy.
Thank you for the opportunity to speak with you today. For me, climate change is an urgent issue that needs to be addressed now. I'm going to share with you today some of my thoughts from my research on climate change and finance as to what I think we can do to move the debate forward. We have a fabulous opportunity that COP26 is coming to Scotland, coming to Glasgow, and is going to be on our doorstep. It's exciting for me, having researched this topic for 20 years now, to have the opportunity to speak to people so close at hand. So I'd like to engage with you in your preparation for COP26 today and think about what we can do to slow the onset of climate change and to adapt to it. And I'm thinking about this as an accountant, as a researcher in finance, and also as a mother, recognising the urgency that is needed for action. Now, as climate changes in the future, how we live is going to change. The resources that we use are going to change, and we need to prepare for that. So part of what I want to talk about is in the preparation for that in particular, because there's a real risk, and this is where the idea of stranded assets come in. There's a real risk that as the climate changes, what we hold dear to us in terms of our resources, if they don't change, they become of less use to us. They potentially become useless to us and useless to others as well. So we need to manage the risk of this change happening and essentially leaving us behind in how we've adapted to it. Climate change is requiring us to change our behaviour. The resources that we will use in the future need to adapt to climate change. We are at risk of what's known as, and what I've previously talked about, as stranded assets. The resources that we use becoming worthless as climate changes, and we are exposed to physical risk and transitional risk. Support from climate finance. So we have two things. We have mainstream financial products, such as banks, bank loans, insurance, equity investment, and investment funds that are considering social and environmental issues as part of their standard decisions that they're making on our everyday products that are provided. But then we also have specialist products that are being developed in line with local, national and international goals, such as the United Nations Sustainable Development Goals. These products may be, for example, supporting decarbonisation programmes. They may be providing investment for us to move forward to a zero carbon future. Demand for information for decision making as part of these provisions of finance is particularly important, and it's focusing on organisations themselves identifying the risks that they face as a result of climate change, what action they're going to take to minimise their impact on the environment and to try to offset these risks, so that the people providing finance can be reassured of what they're getting from their investment, essentially. The big question, I would say, is, are we doing enough? Based on my research, I can see the development of interest with financial services sector and action being taken. But I think it's also important to recognise that, there are laggards in this area that could definitely do more. We need to see the integration of climate issues into all our mainstream financial products, as well as specific product development. If you're interested in doing your own research and looking at what the banks or the insurers that you're dealing with or the pension funds that you're invested in are doing on the environment, have a look at the United Nations Environment Programme Finance Initiative online. This was established back in 1992 as part of the Rio Earth Summit. It's now represented by 130 organisations from the financial services sector, and together these organisations represent roughly $14 trillion under management. We can also look in terms of our international climate agreements at what COP has done in the past. If we look at COP17, for example, this was still the first establishment of the Green Climate Fund, really providing a financial mechanism which was accountable to COP, accountable to parties, where parties were deciding climate finance policy, programs, priority, and also establishing criteria for funding. They were asking different parties to be responsible, to hold governments responsible to a commitment to fund climate finance, essentially. Over the years, this has changed and it's increased. COP19 looked at a long-term programme in climate finance, which took place from 2014 up until last year, 2020. COP21, the Paris Agreement, was looking at enhancing climate systems' role in managing climate risk and mobilising capital, so the specialist products development there for low carbon investments. So at COP26, we have the opportunity to evaluate climate finance and the funds that have been provided by parties in the past, look to see what impact they've had, and also consider together the investment that we need in the future to help slow climate change moving forward, but also to help adaptation to the climate change that is happening around us. It's important that we make those decisions together and we can reach agreement given the uncertainty there is surrounding our future. We need to minimise the risks we face. So focusing on climate-related financial disclosure, one of the primary influences in the last few years has been the Task Force on Climate-Related Financial Disclosure, which was established in 2015 by the Financial Stability Board. This provides a voluntary reporting framework that organisations can use to help them to understand what they need to disclose to make their investors aware of the climate-related risks they face. Now, the 2020 status report that came out at the end of last year from TCFD, as it's known, reveals support from over 1,500 organisations, which includes companies, financial institutions and government, all taking forward the need for financial disclosure in climate-related issues. It highlights the need for transparency, but also highlights the need for us to clarify what our view of the future is. You know, one of the ways in which we do this, we use scenario analysis to say what will the world look like, for example, in 2013. And it's important that when organisations are using these scenario analysis tools, that they disclose those. They say what is the basis of the decisions that they're making, what's the basis of their valuations. They need to be clear. Their accounting policies and the basis for their decisions need to be clear. Now, as you can imagine, accountants are getting more and more involved in this process. It is becoming about not only financial disclosure, but the narrative that surrounds that in terms of also non-financial information and the background decisions that are taken on climate-related governance, for example. This has led the accounting standards bodies to become interested in this area. Essentially, at the moment, there's debate on climate risk disclosure by the International Financial Reporting Standards body. It's recently had a consultation which closed at the end of last year on global sustainability standards and the need for global sustainability standards and who should be involved in their production was one of the questions that were asked. Also central to the debate was, should our focus be on climate risk and financial disclosure, and how urgent is it that we address these issues in terms of requirements from accounting standard setters to report in these issues. So it's moving forward from the voluntary nature of TCFD, potentially in the quite near future, to a requirement for organisations to report on climate-related financial disclosures. It won't become an option. So in summary, my message to you is, let's not wait for us to suffer financial hardship to act on climate change and adapt to climate change. Let's not wait for potentially financial markets to collapse on the basis of devaluations that are felt as climate changes, and we suffer physical and transitional risks surrounding them. Let's act now. Let's use the opportunity that COP provides us to push forward and recognise the need for transparent disclosure. Let's develop accountability mechanisms to hold financial service sectors and financial service providers accountable for the decisions that they're taking on what to invest in and what to invest in on our behalf.
Welcome back, everyone. We'll now kick off the second part of today's session, and I wanted to thank Andrea and Duncan first of all for their presentations. We'll have them live with us here today for a panel discussion. I thought it was really interesting the point Andrea made around the voluntary versus mandatory disclosure, and I hope we can have a chance to circle back to that later. Just as a quick reminder for the audience, it's still possible to submit any questions using Slido, and you can do so throughout the entirety of the event. Then I would like to now welcome Charles Langen from Scottish Power. He's the Finance and Resource Director, stepping into this role in last June. He now leads a team that includes everything from IT to procurement to risk and investment. So I think he will be very well placed to provide us with a very valuable business perspective today. Charles, I understand you're also an alumni from the University of Strathclyde and that you obtained a degree in accountancy and finance. So given that, I'm sure that Andrea's presentation was really interesting to you, given that background. Would you mind sharing your initial takeaways from these two presentations?
Yeah, sure, Lottie, I'd be delighted to do that. But first of all, just a thanks to you and also to Duncan and Andrea for being part of this session this afternoon. You know, Scottish Power are very proud to be a sponsor of COP26, and it's great to be able to host these sorts of events in the run up to that. You know, going on to Andrea's presentation, I think the first feeling I had from it was really pangs of guilt. And that was because I was such a terrible student at university, and I thought of all of the lost opportunities to really study as hard as I could when the football team and the student union seemed much more appealing at that point in time. Once I got over the guilt, I then started thinking how long ago it was. I was at uni, and it was 25 years to, well, not to the day, but to this year since I was there, and I thought I'd miscalculated, but no, it is actually 25 years, so that made me feel quite old. But then thinking about that and where I was at that point, and in fact where accountancy and finance was at that point, was that international financial reporting standards hadn't, you know, we were moving towards a convergence of those at that point. And in those days, the good old days, we were in UK GAAP, and you know, France was in different standards, Spain, etc. And the push then was towards convergence on that. And back in the 90s, that was seen as the goal, but without a clear path to how to get there. And of course, without making a history lesson, we certainly got there, you know, over time. And I guess that's how I kind of feel where we are in some of this journey we're on just now, is that there's a clear goal, but the path there is still a bit rocky and unclear at points. And I think, you know, the point Andrea made on TCFD, you know, voluntary disclosures and these sorts of things, I think that sort of thing is a really good start. And of course, Iberdrola, Scottish Power's parent company, and Scottish Power ourselves, we were one of the first signatories and companies to look to disclose that. And in fact, we did that as part of our 2019 annual report published earlier this year. So, you know, that's something that I think is very important, but I think it's the beginning rather than the final solution. You know, the other point Andrea talked about, I guess, on the stranded assets, I think is key as well. And that's where, from an investor point of view, you know, company selection, company research is hugely important from that point of view. And from a Scottish Power point of view, and Iberdrola, I guess we're very, very fortunate because of where we are in our positioning in the sector, and such a focus on renewables, that, you know, where we're going with green energy and our investments there, which I'll probably touch on a bit later, our risk of stranded assets is very, very low. So we're pretty comfortable with that. On Duncan's presentation, there were a couple of interesting points as well. You know, the green bond situation, and you know, I think 10 years ago, green bonds didn't exist. You know, they were an idea, but certainly hadn't been deployed in practice. And then, I don't know, 5, 6, 7 years ago, maybe the first one started to come out, and it was not quite the Wild West, but there wasn't clear criteria as to what qualified as a green bond or not. And Iberdrola, was one of those first issuers of green bonds at that time. That's evolved since then, clearly. And now we're up at, I think, 25% or thereabouts of our debt is actually green bonds. And we forecast by 2025 we'll probably be up about 50% of that. So that's absolutely, I recognise the figures Duncan's talking about there in terms of the really significant growth that's happening. And then final point, if I may, on it, I think Duncan's point on the technical changes and technological evolution. I think on some of the technologies we've made huge strides already, particularly in the wind sector, offshore and onshore wind. I mean, offshore wind, the most recent auction we had there for capacity, it was the auction cleared at a price lower than the wholesale electricity price in the UK. So this isn't about subsidy anymore, it's about price stability. So from that point of view, there is no economic restriction on being able to roll out wind as quickly and as fastly as possible. And solar, I think Duncan mentioned that, 10 years ago, solar needed a subsidy in Spain for it to be economic. And now you can do it without a subsidy in the UK. And I'm sure most people are familiar with the climate differences between here in unsunny Glasgow and the south of Spain. So, that just shows you some of the technological evolutions. Are we there yet? Of course not, because you've got things like batteries, battery technology, hydrogen, these sorts of things. There's still huge technological challenges that are there. But if you look at the track record of what we've done so far, I think the opportunities and the optimism, I think we're right to be there.
Excellent. Well, interesting that you're mentioning technology there, because I thought it was a really interesting point that Duncan made, actually, where he mentioned the need for, I think when most people think about green investments, the first thing they think about is renewable energy, especially. Like, that's, for me, as someone who's not that familiar with it, is the first thing I think of. Duncan, I feel like your focus is a bit more on housing and infrastructure. You made the case there for that being your focus. Can you elaborate on that a little bit and how that relates itself?
Yes, I think that the focus on energy in the first wave of all of this was very obvious, because the link between energy production and carbon was very direct. Yeah. But if you take infrastructure, infrastructure is either the structures we live in or the structures that connect us. So if you want to look at residential emissions, about 20–25% of Scottish emissions, if you want to look at all the transport-based carbon emissions that there are in pursuing the activity patterns generally, and not just commuting patterns of households, they're really significant. They're what we're trying to change. So that when we do this, we have to be thinking about how do we raise funding and make decisions about infrastructure that fully capture these effects. And I think we've begun to do that, but it's slow. There are some funds that do specialise in looking at the ways in which taking into account environmental considerations will influence the narrow return, if you like, on the infrastructure investment, but also much more widely in terms of the wider effects. And of course, two things about infrastructure: you have to put it in place somewhere. So it's very place specific, but also it lasts a long time. So the time horizon to 2050 is well within the decision framing for any infrastructure decisions we're making. So it's really important, but there are quite active signs of bonds financing with a green dimension in the context of certainly infrastructure. As for housing, probably the biggest post-COVID economic renewal project in Glasgow is the energy refurbishment of the older tenement housing stock. And nobody's really paid much attention to the financing of that question yet, but there's a whole set of assets underneath these buildings. They need to be looked at, leveraged, and clever financing used to drive that change without a huge burden on the public purse.
Excellent. I think we've got a lot of questions coming in from the public, so I'm going to have a quick look. The first one that I wanted to relate this to, because you mentioned place, is how can we measure the collective impact of businesses in placemaking by city of locality towards the goals? That's a question from Miles, I think, from Edinburgh Napier.
Is that to me, Lottie?
For sure, yeah. If you want to take that first, and then I'd also like to hear from Andrea what her thoughts are.
I think that that's a very difficult question, because in placemaking we're talking about the social and the inclusion and the economic goals as well as the environmental goals. I think that in the context we're presently in, we're asking city regions and other regions in Scotland to develop fairly sophisticated strategies without having the real capacities. We've reduced the number of town planners in Scotland by 40% in the last 10 years. So if there's a public involvement in this, which there has to be, the capacity to actually respond to this is much more limited. I also think that government has to be very precise and clear in its strategic targeting of infrastructure investments and planning decisions, and that's not the case yet. There isn't actually a single coherent infrastructure and placemaking strategy for any of the Scottish cities or indeed rural areas. Just drawing up a strategic spatial plan doesn't actually mean anything unless you line up financial resources and the vehicles to deliver that change. We're a long way from doing that. So our placemaking's got to significantly improve the green dimensions within it.
Andrea, would you like to share your thoughts?
Yes, certainly. I think certainly for me, it's a very important question. It's one that centres not for me around measurement, but one around values and how we value things. Certainly, you know, it's difficult from a measurement point of view, and it's also difficult from a values point of view. But I think the importance of place, particularly in the recent pandemic, has been highlighted as being particularly important. That the local is important, and I think we can look at the collective impact of business in terms of how we value that impact and what difference it's made to our everyday lives, and start to think sometimes beyond the financial as well in terms of the investment that's been made, but also to the intrinsic benefits that we can get from this, because the reach of this impact is so wide.
Yeah, absolutely. I had a question around metrics, because I know that Duncan mentioned earlier that one of the three major challenges around linking investment to green outcomes is plausible, like good metrics of that. Do you have any examples of metrics that are already out there, either for Andrea or Duncan, and kind of where you see the most potential in that?
Duncan, I think to take that.
Do you want to go first, Andrea, or
you go first, Duncan? I'll come in on the back of that. Thanks.
In terms of metrics, we're talking about metrics, I think, that relate to households. If we're going to change consumer behaviour, they don't get discussed a lot in the context. We're talking about metrics for corporates making investment decisions. We're talking about metrics for financial institutions that are taking lending decisions, and we're talking about metrics for governments and international governments. So there's quite different sets of metrics, and one might think that, oh, we could nest them and aggregate across, but it would be fair to say we can't do that presently. One, because there's a range of different approaches and metrics within each level as well as across each level, and I think it would be fair to say they're a work in progress. When looking at this area, I think that when we were talking about really socially responsible investment, whether it was for green or other purposes, we essentially were doing a scan in trying to identify whether a particular investment project had bad effects. Just did it have a bad effect? And that was very much as a binary rather than as a measured quantitative effect. So that for a long time in this area, really when we were working with the more altruistic motives of individuals and corporations, there were metrics, there were indicators, but in a sense they weren't hard, they were fairly crude, and they were almost entirely qualitative. I think there's a completely different context now, and in the context of either corporates or financial institutions, the question is changed. There are two questions. One is, what does the proposed investment or proposed strategy do to the market return or the value of the corporation, as well as the sustainable development goals involved? That's a tough question. And above that, there's then the question for governments, is how does this actually not just play into corporate interests, but to broader societal interests, sustainable development goals of the United Nations, and so on. And I think that where we are just now, pretty much up until, I'd say, 3 or 4 years ago, there hadn't been huge progress on developing indicators that were capable of being metrics rather than just giving a broad indication. I think that's changed most in the energy sector, but I think that it really needs to get to grips with the issues in the other sectors we've mentioned. I think that we need to look to better data and better work. In fact, I think there's a case for national and government guidance or even government requirements about the ways in which indicators are provided, and the ways in which data are used, the methodology, and the disclosure of these approaches, both in the corporate and financial world, because at present they aren't really. And I think that that would make a major breakthrough in being able to compare from one to another. But I think that there is actually, and the financial sector has, and pension funds and investment insurance funds have pushed hard on researchable ideas that are actually making much better sets of indicators, but also exploring the logic chains that underpin them. So there's a lot of work to go in this area, but as I suggested in other areas, I think there's some progress.
Yeah. What is your take on that, Andrea?
I think we also need to think about indicators going forward. We mentioned the importance of looking in the future and scenario analysis. Certainly there is a network for greening the financial system that is working on the development of different scenarios for the future, and the indicators embodied within those, I think, are particularly important. So there are tools that we can turn to when we are imagining the future to help us in our decision making there as well. And I think that we still have the same problems around what those metrics represent and what's most appropriate to us, so that we must question the assumptions behind them. But certainly I think they're key going forward as well in our decision making.
Excellent. I wanted to pivot a little bit. It still relates to the future. I saw a question coming up from the audience that says, how can accountants and corporations be climate friendly when GDP has to shrink in order for us to address climate change? Surely the financial and business sector emphasis on profit has to be replaced by wealth distribution and mutual aid. So this is a vision of the future where GDP and business growth doesn't really have a place. Charles, would you like to share your thoughts on this first question?
Yeah, sure, Lottie, more than happy to. I think I'm not convinced there that GDP has to shrink for us to address that climate change. I think where we sit just now in terms of the pandemic and how we look to recover from this, I think this gives us a huge opportunity, and could be the one good thing that comes out of this, and that is the green recovery that many governments, including the UK government, are talking about. And it's that ability to build back better, to make those investments in a greener society and a greener economy. I I think that's a huge opportunity, and one that we need to look not to miss, because that ability to build back is coupled with unprecedented, low rates of finance that are available. So, money's there, and the willingness on the corporate side is there to do it as well. And, from a Scottish Power Iberdrola point of view, what we're looking at is 75 billion euros of investment over the next 5 years as part of that green recovery. 10 billion pounds of that here in the UK. And 75 billion euros is the equivalent of Iberdrola's market cap, more or less. So it's a huge investment. It's a massive ramp up in terms of what we're doing. 10, 15 years ago, we were maybe at 3, 4, 5 billion euros a year across the entire group. So, I think the money's there. I think it's really if the appetite and the willingness is there across the broad corporate base to be able to do it. And, some companies are further along than others, and some we need to watch as well around some greenwashing in terms of, are they really doing what they say, and are they doing enough? And one interesting stat that I think Reuters published at the tail end of last year was that, Iberdrola's investment in renewables energy is more than the 6 major European oil companies combined. So, they're pushing towards it, but I guess my challenge to them and to others is, can they do more? Should they do more?
Could I add something to that, Lottie?
Absolutely.
I don't. There are 2 parts of the question that I don't agree with. I agree with, I think, what is an implicit goal. Mm-hmm. The first would be, and particularly with the development of some of these much more low carbon technologies, and the fact that creating them not only reduces carbon, it actually drives economic growth of a particular kind. The equivalent to the stranded asset on one hand is the growing sectors of new technology and green jobs. And I think that when you look at the economics research in that now, that most of the high level estimates would tend to suggest that by 2050, something, or 2030 at least, GDP is unlikely to be more than 1% less than it otherwise would have been. And there are an increasing number of estimates suggest it will actually be higher than it otherwise would have been. So the presumption that a system has to shrink to become green, I think, is now questionable. Now, some people will say, well, that's just going to drive higher standards of consumption. But the argument to that would be governments always still have it in their capacity to introduce carbon taxes, so that if there is growth induced by new green technologies and a fiscal framework that actually diverts our activities to less carbon intensive, we haven't mentioned biodiversity, which I think is just as great a crisis potentially as carbon. We can actually change consumption patterns that are less inimical to these really critical parts of sustainable lives. So I think that we need to look at that again. The other thing in the question is it says we should be promoting redistribution and reducing profit. Well, I think that if you redistribute, and I agree with the object of redistribution, but I just point out that redistribution will tend to lead to an increase in consumption because poorer households have a higher propensity to consume out of their incomes than higher income households. So that little circle would have to be squared. What I'm suggesting is, and I'm not somebody who believes that technology is always the answer. The critical things are behaviours by individuals and governments. But I don't think the question has the inevitability of an answer that there would have been 10, 15 years ago, simply because so much is changing in technology and recognition of the problem. And indeed, my point earlier, governments have to get a grip about their willingness to tax the bads if we're going to continue to grow.
Lottie, can I come in as well, please?
Yeah, absolutely.
I think what's important to recognise is that we are seeing a change in the nature of the business case as well. That, you know, that certainly there has been in that profit centre that we've always recognised going forward. But I think that we're seeing a new development of values-based business cases where we're looking at value creation for the organisation, not just in terms of the financial wealth creation, but a values basis that holds the social issues, nature, as a priority as well, in terms of the maintenance of resources that, as I said previously, we can't necessarily put a financial value on. So I think we are seeing a shift, so that we're bringing in corporate social responsibility, we're bringing in more ethical values into the organisations and creating a value-based business case that recognises that that value creation isn't just about the financial. So we are progressing in that sense.
Yeah, really good points. And I was quite curious to hear a little bit more from Charles around how that looks like, what that sustainability strategy looks like at Scottish Power, and how you communicate that to the parent company.
Yeah, sure, Lottie. A few bits around it, I think. So when we go forward with our investment plans to the investor community, we talk about a number of things. We talk about profit goals, we talk about investment goals, we talk about dividend goals, and we talk about really two dividends within that. One, the traditional dividend, if you like, the payment of the two dividends a year in cash to shareholders, but we also talk about our social dividend, which is the non-cash contribution to society. Okay, and you know, that first bit I've talked about, I think hopefully most people on the call would recognise that sort of environment as to what we're doing, but our commitments on the social dividend element are as strong as what they are on the financial. So things that we put forward, so you know, the obvious metric for us is how much CO2 do we emit per unit of electricity produced, and our commitment there is to, within Europe, to be net zero by 2030. And you know, to have reduced overall emissions across the Iberdrola group by 86%. And of course, for Scottish Power, our contribution to the group on that is, you know, we're already the first integrated utility to be 100% renewable energy, which, you know, is a huge transformation that we've undergone. And so the investors can see not just what our plans are, but what our track record has been on that regard as well. So, you know, 2005, 2006, Scottish Power, about 90% of our generation was thermal, and over half of it was coal, and now today it's 100% renewable. So the track record's there, but the future goal is absolutely there as well. So one is a metric on that, which is obviously the environmental climate change type piece, but there are two others there as well. It's the full ESG, environmental, social and governance. So, you know, the social bit, a number of metrics we commit to there, one of which being gender pay gap and the balance there. And then on the governance, there's obviously the corporate governance aspect to it, but it's also a new one that we've brought in last year was on supply chain development. So what are we doing as a company is one thing, but are we bringing the supply base with us as well? So we've got a commitment in there to drive our suppliers to have sustainable policies. It's not something we're pushing them to overnight because we would decimate our supply base, but what we're saying is over the next couple of years, this is what we're looking for you to achieve. So that's the commitments to the market. If you like, how do we ensure management are focused on helping drive that forward and not just on profits? It's quite simple. The long-term incentive plan for the senior execs of the group has an element that's linked to these social dividend type aspects of it. Excellent.
So it's really embedded in the organisation, yeah.
Yeah.
I think we have time for one more question, and I wanted to first put this one to Andrea, because I really appreciated your kind of overview about COP and the previous COPs that have taken place and the implications of that for the green investment sector. I think as a final question to each of the three panelists, I was wondering what your expectations and hopes are for COP later in the year, whether you expect it to just be a reflection on efforts that have been made so far, or whether you are expecting any major announcements to be made there. just curious to hear your kind of a look ahead at later in the year.
Thank you, Lottie. Certainly, as an accountant, I would say we need to look back to go forward. And I think we do need to see what progress we've made towards the Paris Agreement. Certainly, there will be emphasis on this. And even looking at the funds, we haven't got the final figures in for 2020 yet. You know, so I think it's 2022 is estimated to get final numbers in terms of investments for 2020. But certainly moving forward, Alok Sharma, the new president for COP26, and Mark Carney, financial advisor for COP26, have both talked about turning the climate finance into trillions of pounds moving forward rather than billions of pounds, and they've made statements about how this might be done. I think what's most significant is that in terms of private sector finance in this area, that we've seen it represented in terms of what disclosures can be made to hold the financial sector accountable for what they're doing. And I think the same needs to be said of government. So I would hope that we can see how we can scale up our climate finance to that which is necessary, and also how we can hold those who are doing so accountable, so that we can see what impact they're having. It's not just for me about talking about big numbers, but it's actually about looking at the impact of those and how it can affect our everyday lives in light of climate change and climate adaptation.
Excellent. Any thoughts there, Duncan? I saw you wanted to jump in.
Two things. One would be, I do think there has to be further progress on mandatory regimes. I mean, Charles was quite rightly stressing the good work that Scottish Power does. I'd highlighted the absence of many of these things in the firms that are in the London FTSE, and they're big corporations and they're not quite getting there. I think that mandatory disclosure on the sustainable development, and some of the European legislation is going in that direction for financial intermediaries. I think that's really important. And I think in the realm of government, looking more locally, I think this is a time for the Glasgow City region and Scotland to really articulate what their coherent forward case is for actual investments in energy transmission, infrastructure, and so on. In other words, I don't think we as local hosts to this should be mere sideshow applauders. Let's show what we're going to do and commit the resources and organisation to do it.
Excellent. Charles, did you have any idea, any hopes or expectations?
Yeah, sure. Sorry, Lottie. Yeah, absolutely. But I would echo what both Andrea and Duncan have said on that. I think the three bits for me would be the urgency that's required, the fact that the recovery has to be sustainable, and really look for that acceleration in all sectors of carbon reductions. I think that would how I would encapsulate what we'd hope to achieve.
Excellent. Thank you very much. I think there is loads of questions still that we won't have a chance to cover all of them. Just on a quick look, I think I'm really hoping that if there's any other takeaway messages that you'd like to share with the audience. I think we have about a minute left. I think it was a really, really interesting call. Really thought we could have spent like another half an hour hearing from our brilliant panelists. Appreciate that this is only the first in a series of events, so I'm hoping that we will see many of the audience in any of the future Connect with Climate Change series. I know the next one is on the 18th of March. The topic of that will be announced on the website of Scottish Power, so if you have a look on scottishpower.com, you'll be able to see and sign up. Then the last thing I would like to ask from all of the participants is to fill out the questions that will be popping up on your Slido screen. These are for gathering feedback and just to make sure that any future events are fitting for what you're hoping to get from Scottish Power, the University of Glasgow and the University of Strathclyde. I'd like to thank our panelists again for their thoughtful participations, their presentations and their great answers. I've learned a lot and I'm hoping that the rest of the audience has as well.